Welcome one and all to another thrilling installment of Patreon member Q&A, where my Patreon members ask the questions and I, based upon my 27 years of investing experience, attempt to provide answers. And if you want to ask me a question, I encourage you to join my Patreon. There's a link in the description of the video. And remember also that this is not investment advice, just sharing my opinion on strategies and investing techniques based upon my study of many famous investors and my own trading experience. And with that, let's get to the questions. This first question is from Leanne, and it is a doozy. There's a lot to unpack here, but I do have some things to say about it. Let me read it to you. She said, trying to define your own trading style in regards to how long you hold your positions can take quite some time. Seems to be based on your personality and knowledge level. Scott St. Clair is in and out like the wind. David Saito Chung is a long-term holder who tries to 10x his trades. You and Mark Minervini seem to be mid-term holders, not sure what to call it, momentum/swing. David Ryan seems to do everything. He was buying gold last week and selling this week. How long did it take you before you settled into your style? You're very consistent, which is great for us. Otherwise, learning would be too difficult, at least for me. Thank you, Joe. Wow. Okay. So how long did it take you before you settled into your style? Honestly, it took me about 20 years. But I didn't have the advantages that there are today. And I think you can figure out your style much faster. For, a big part of my trading career, there was no YouTube. I didn't have a trading mentor, a YouTube trading mentor, or a live, human in-person trading mentor. I had access to books, but I had no idea which books to read, and I stumbled upon them by trial and error. And these spectacular software programs that we have now, MarketSmith and StockCharts.com, with their screeners and their annotations and so forth, these didn't exist when I started. And then they were very crude and rudimentary, and only recently have become so powerful. Recently, within maybe the last 15 years. Okay, I just took about a 45-minute break. The internet guy came. We had to walk around the house, outside of the house in the dark, trying to find where the cable goes into the house, and it was quite a fiasco, but got it sorted out. So I was trying to answer Leanne's question here, and like I said, it took me a long time to figure out my style, but I think, and to hone my technique, so to speak, but I think you guys can do it much faster. That being said, people don't expect to learn how to be a brain surgeon in 6 weeks, and while stock trading is not brain surgery, it is really complicated, and I think it's a multi-year process. Now, I will tell you what I think the best style is. I think after studying and trying out a myriad of different styles, I think the best style is one where you adapt to the market. So and what I mean by that is by what phase the market is in. Right now, we're in an early bull market, and that's when you get these leaders that emerge and can stay in uptrends for many weeks, sometimes multiple quarters, sometimes a year and a half. And so this is the time when you can latch onto some leaders and do multi-week, multi-month positions. And then when we get later stage, I start trading a shorter time span, maybe a couple weeks, 3 weeks on average. It just seems like the uptrends between the bases are shorter. And then ultimately you get into either a whipsaw stage 3 top or into, stage 4 bear market. And so whipsaw is really difficult to trade in. And if you're going to be trading, it's generally going to be just a few days at a time. And then bear market's the same thing. It's best to go in cash or for me personally, it seems like I do better when I do high frequency trading, the longest positions just a week or two. Now, a couple other things to say. One is I really think you should try to specialize. Figure out what type of investing, like Leanne says, suits your personality, and try to learn everything there is, everything you can about that one type, whether that's a multi-year buying stocks at a value and holding them to as they appreciate, whether it's kind of mid-length swing trading like Mark Minervini, and I try to emulate that for the most part. Whether it's Japanese candlestick trading, whether it's point and figure trading, whether it's day trading or options, I would pick a style, figure out everything you can about that style, and once you got that wired, then that's when maybe you widen out a little bit. And the same goes for stock mentors, whether it's a real life person or a YouTube almost a YouTube personality like myself, or an investment author through books. Pick one that resonates with you, that you can understand, that suits your style, and read all of that person's books or watch all of that person's YouTubes, and just kind of funnel in, concentrate on that person. Otherwise, you're going to end up paralysis by analysis. You're going to start learning about so many different indicators and oscillators and strategies that you're not going to have one. You're going to become a jack of all trades, and maybe being a jack of all trades is good to be as a person, but as an investor, that's not. I don't advise that. I don't think that's a good way to make money, trying to know a little bit about every style and every strategy. And as far as my developing my trading style, I started in 1996. I got a hold of a Motley Fool book, and then I think I was paying for their newsletter, like $50 a month or something, which is big money in those days. And I learned about value investing. I knew nothing about charts. And then somehow I stumbled on one of William O'Neill's books, and boy, that really resonated with me, and I became a William O'Neill disciple. Read every single one of the O'Neill books and subscribed to MarketSmith, and he's still a very big influence in my trading. Then I came across kind of the Bible of chart patterns, Thomas Bulkowski's Encyclopedia of Chart Patterns. Studied a bunch of Bulkowski's chart pattern books, and then lastly, I heard Mark Minervini in an IBD interview and was really impressed with him and read his books multiple times. And then I joined MPA for 2 years, and I recently quit MPA, and not because it wasn't still helpful, it was, but I feel like I've pretty much got his style down, and so now I want to work on some other types of trading. Let's move on to the next question. Okay, Charvel says, I hope I'm pronouncing that right. Please critique my IOT trade. Entered 12.4 on weekly break of the large, well-formed IPO base at 34.5. Stop loss at 29. Was there an earlier entry? The recent breakout was on earnings. Okay, let's look at that. Okay, IOT, Samsara Incorporated. This is the 5-year chart. You got a big cup with handle breakouts, definitely in stage 2. You've got a double bottom in the cup. That is what's known as a fractal pattern within a pattern. This is almost a base on base. Here's your cup, here's your handle. Then you got another base on here, and you got a double bottom in that base. Let's zoom in now. So here's the most recent base. We can draw a line of resistance right, pressing the wrong button, right about there. Okay, now he got in on 12.4, right there, a weekly break of the large well-formed IPO base, 34.5. Was there an early entry here? Yeah, definitely. And I think this, I mean, I see what you were doing. You were waiting for it to clear the last remaining supply. And I'm not sure if you missed the breakout day here or if you wanted to just see if it was going to extend. But where you bought here, this is the kind of entry I used to do all the time, and I often got stopped out, and I didn't know why. Because if you think about it, where you bought, I mean, look at that. That is 20. That stock has run up 20% in 2 days without any pullback. So what are these guys that bought right here, which would have been a really good entry point? A lot of them are swing traders. A lot of them are going to sell right there. So I don't actually like that entry point. I would have preferred to get in. Let me just move it. So here's your double bottom. So look, you got a ascending 200-day simple moving average, and it sits on there for a few days, and then it blasts off strongly on good volume. So I would be comfortable putting on like a quarter position right here, and then the next spot would have been right here, although this gap is a little bit, let's see how big that gap is. Yeah, it's only 2% or so. Now this is always so easy in hindsight, right? But in hindsight, we put on a quarter position here on the bounce off the 200-day. Then we add to our position here, bump it up to about a half. This is, you got a base here. You got a platform to trade off of. We can call this a low cheat. This is cheating on the low cheat. And then here you've got a pretty traditional handle, pivot area, breakout above there. Ordinarily, this would be a good buy point, but 2 days before earnings, I wouldn't buy 2 days before earnings. So in answer to your question, yeah, I would buy here and I would buy here. So now, I mean, you're still probably okay. We got a strong market. I don't know the fundamentals on this one. Probably it might make a cap here where it rolls back down to 32 or so and just pauses out for a while and then moves to the upside. That would be most likely. Now, if it's behaving normally, usually you'll just get 3 or 4 down days. So you've already got 2. So after 2 more down days, it should start moving up again, or at least sliding sideways. So what we can learn from this, so yeah, you want to buy a breakout in an early stage bull market. Definitely we want to be buying breakouts. But if they're this extended like this and you missed it, then wait for it to come back in and do a pullback buy, or wait for it to break out of that cap type formation. And ideally, maybe you can get a better pattern where it runs up closer to the line of resistance here and then makes a tight drooping handle and then breaks out of the handle, and then you have a nice tight pivot area. Like imagine if this handle formation had built up right there. That would have been optimal. Okay, NIO AMP 4th of December at $60. Please give some feedback. Normally the setup would be too short, but at the moment I feel like those setups are working. Yeah, AMP is one I know well. Injections, nasal sprays and such. It has good numbers. Look at these triple-digit earnings, 50% sales, good gross margins. So this is a very profitable pharmaceutical company. This is one I've been in and out of. Here's the long-term chart, relative strength of 95. That all looks good. Now you got in at you got in December 4th. And I'm pretty happy with that entry point. Obviously, it hasn't gone the direction you'd hope thus far, although I definitely wouldn't worry about it. If you look at the volume on those 2 sell days, the volume on the sell days was low. The volume on the breakout day was high, as were these. You want big volume on the way out. You want low volume on the way in. And yeah, we're seeing a lot of these bases with compressed right sides. Normally you want them to be symmetrical, looking quite similar in shape with lots of oscillations, but we're getting these little short stroke pivot areas. We're seeing a big blast off, generally on earnings, and then a little short stroke pivot area, and then a continuation. And so, yeah, I would have been comfortable buying that as close to the breakout point as you can, right there. And here's a couple examples. This is PHM, same kind of truncated compressed right side pattern. Look how it's just making these little short strokes and taking off. And then tolls the same way. See that? Compressed right side, and it just goes. So little disappointed that you didn't see the same price action. Now there's some supply over here, including this wild action. So I guess it makes sense that maybe it's going to spend some more time over here. I personally, I would just give it some more time. You can do a 10% stop. 10% will get you down to the bottom of this pattern at 54. So if it's a small position, you could do a 9 or 10% stop. If it's a big position, maybe you want to put half of it below today's low and then the other half down here at 54. I think that one's going to work. You just might get bucked off and have to re-enter again. Okay, CVX/XOM. Is it time to pick a bottom on a bounce with volume or look to short? Okay, so the oil stocks are tricky. They are cyclical, right? They go up and down in cycles. In my opinion, oil stocks are not good stocks to hold for years at a time. Generally, an oil stock, you can do well with them, holding them for multiple weeks or months during the right cycle. But they're tricky because not only are you battling company news, but you are also battling the price of oil. And by battling, I mean facing unknown volatility. Chart patterns work pretty well, but when you have company news, then that can shake things up. And then here, if the Middle East suddenly opens or closes the spigots, it's going to tank or explode your stock regardless of the technical patterns. And I'll get to your question in a minute, but here's a 10-year chart of oil. Huge run up from the nether regions of COVID here. Built out a left side, and now it's kind of in a trading range. It's retesting this lower area of 70. Oil is definitely coming down right now. So based on the price of oil, you would definitely not want to be long these stocks. Looking at the 1-year chart of oil, we had this fulfillment of the head and shoulders coming down to support at 72. We will see if that is the bottom on oil prices. Oil prices are also seasonal. They spike in the summer, right? Now, as far as CVX and XOM, I was looking at them on MarketSmith. ExxonMobil, long-term chart, I mean, there are a lot prettier charts out here, honestly. Many years of sideways price action. It did make an all-time high, but now it's rolling over. The only good thing about it is it's got a 4% yield, but that's not enough to keep me in the stock. Personally, looking at this, I would definitely not want to be in. I would definitely not buy it today, that's for sure. As far as shorting it, this is the 5-year chart. I mean, we can kind of draw a line of support here. I suppose if it broke this line of support and then bounced back and then started coming down again, then that would be your short. This definitely looks like you'd have a better chance at a short than a long, but it's not really in much of a confirmed downtrend yet either. This was just to stay away from for right now. If I owned it, honestly, I would probably sell it. But no, if you're trying to live off a dividend, then you could make. I think their dividend is pretty stable, so you could make a case of just holding it for the dividend. CVX, I think, is pretty similar. This is Chevron. Let's look. Same kind of thing. And oil stocks are like birds of a feather. They flock together, right? Got pretty sideways price action for years. You got this run up, and now it's coming in. It's right on support here at 140. here's the 5-year, 10-year chart, sorry. You got kind of a rectangular area here. You can draw, well, can't really draw a line there. You could draw a line there, which has broken. Now this one, you do have a little bit of potential shorting because you got this big drop, probably on earnings. You got a little dead cat bounce, didn't bounce much, tried to bounce again, made a lower high, rolling over again. So this, you actually could short this here and put your stop up here at 147, and you know, you might be able to swing trade it for a 10 or 15% short to the downside. But these are, I would just stay away from these if you're not, unless you want to do that. I think there's a lot more money to be made right now in growth stocks, not cyclicals. Okay, JJ said, if you could explain why PSX and Uber printed red candles on the days they gapped up recently. The only rationale is because the close was lower than the open, but I thought candles were based on the previous day's close. So if a stock gaps up, how does it print red? Hope we can figure that out. Okay, JJ, well, this is a little perplexing. I'm looking at Uber here. One thing is you might just not have your chart settings set the same way that I do. So I'm using stockcharts.com, and I just have traditional candlesticks here. Perhaps you have a different setting here, or perhaps if you're using a different platform, there are multiple colors that you can use for candlesticks. So for mine, Uber did this gap up, and then it printed a black day. Black means it was above the previous day, but it closed below the open. So it opened here, ran up to here, ran down to there, and it closed to there. The open was higher than the close, so it's black. A white day is the opposite. Open is lower than the close. And then the next day after this gap, it printed this little red. That is a gravestone doji, if you want to get technical. And it's red because the close is lower than the close of the previous day. So that's why my chart looks like that. If it printed a red candle here, you must just have your settings different than mine. PSX, so here's your gap up. And then for me, it printed a black candle again because the open was here, ran up to there, ran down to there, close was below the open, but it was still above the previous day. So it wasn't red, it's black. That's all I can tell you. Okay, Tony wants to look at Hood, ALB, and NIO. I know NIO. I made a lot of money on it in 2020. And Robinhood. Let's look at Hood first, and then let's do one from Eaton here. Well, let's see. Let's do 2 from Tony and 2 from Eaton, and then we'll see what time we're at. So let's just take a look at Robinhood. So Robinhood is a fairly recent IPO. It's been around a couple years. They had the misfortune of IPOing right near the top of the market. And their first months of trading were in the bear market. And then also, I think they got in hot water. Don't quote me on that. But there was something to do with not meeting regulatory requirements, something along those lines. In any case, it took an absolute drubbing here, and we can see there's just a ton of supply. It's in a stage one base. It's been sliding sideways, and it's cleared a lot of these trapped angry buyers. We have a little bit to deal with here. Let's zoom in and look at it on stockcharts.com. Looks like they are still losing money. 2024, they are estimated to finally start making some money. Let's just look at the fundamentals too. Sales are decent, 29%. I'd like to see bigger numbers on it. If a company's losing money, I'd at least like to see the sales numbers be really big. Gross margin is pretty nuts. They make 92% gross margin. That's extraordinarily good. This is a money-making formula they've got. So why are they losing so much money? I don't know. Someone figure that out. Let's look on stock charts. Here's the 1-year chart. This is just so wildly volatile right now. This looks like a day trader's playland. As far as doing low risk, high reward trades with tight stops, this is not the kind of pattern chart that you want to be trading off of. You see it made this launch off the bottom. Now you could have used Japanese candlesticks here. You've got, see these 3 white candles in a row? Actually 4 of them here after a long downtrend. That's called 3 white soldiers. That often signals a turn of events, a turn of trend. And you've got the same thing right here. Look, you got a doji, spinning top doji, and 2 more. So that's a variation of the 3 white soldiers. And you could have traded it in that way, spinning top doji and undercut. So you could do some Japanese candlestick stuff or some day trading and so forth. But as far as trading this thing, I would wait. I'd rather get in on a higher, safer price. What I would wait for, I'd let it clear all this supply up here, like 12.5, and then if it would set up a nice tight handle for me, then and only then would I institute a trade on this one. Now, if the market gets more speculative, then we might see it run up to 12.5 and make that handle, because Hood is a kind of a risk on speculative stock, right? Yeah, Albemarle, this is a chemical company. They might have something to do with lithium, if I remember correctly. That might be completely wrong. It's a good money-making company. They do have a little small dividend here. It's pretty cyclical. If you look at the chart, yes, it is in an overall an uptrend over the last 20 years, but you get these long, multi-year sideways movements with a dividend of 1%. No thanks. I don't want to be sliding sideways for 3% with a 1% dividend. Relative strength of 8, that is terrible. Minervini, with the exception of IPO basis, he trades stocks that have a relative strength of 88 or higher. This is called an inverted scallop. Now, it's very possible this scallop will come down to 100 and bounce and start working the other direction. So if you wanted to play a 𝗕𝗨𝐬 pattern, you could look for that scallop to complete and try to play a bounce off the $100 mark and do a swing trade. But yeah, in the 1-year chart, this is a stock that's in a downtrend. I would not be going long on this. And this, I mean, this would look more like a short than a long. You could draw, here's your trend line right here. You got a little bit of a ledge here. You could, when it hit 130, if it bounced off, you could initiate a short there with the idea that it's going to push through the bottom there. Or if it ran up here and bounced, see how it's kind of bouncing off of this 50-day, you could initiate a short on one of these bounces near the 50-day. But I don't really see anything attractive on this one right now. Okay, Eaton, critique my trade. ACGL entered 11.27. It's across 87. Stagger stopped out a half at 81.61 on 12.5. Planning on selling the rest at a second close below 80. Let's see here. Let's snip that. Yeah, ACGL, this is an insurance company, a great long-term chart, no dividend, making good money if I remember right. And this is one of those where the trend is your friend until it ends. And for the moment anyway, the trend has unfortunately ended. Yeah, this company is making good money. It's got great fundamentals. So you had this nice multi-month trend channel where you could certainly have bought the bounce off the lower trend line, and if you wanted to swing trade it, you could sell at the top of the trend line, and it just broke through, so you bought it. I was just figuring out your buy point. Your buy point is right here. So I kind of see what you're doing here. This is kind of a pivot area. This is so wide and loose though. That's really not. I'd want to see a tighter pivot area like this or this that broke to the upside, like right here. See this tight pivot area and then a move to the upside? That's the kind of pivot area you want to be trading off of. This, I can see you waited for it to clear the supply, which is good, but this is so wide and loose, so I don't really care for that entry point. An alternative entry point, you could have, here's the gap up on earnings, and then sold off, bounced, sold off, and then when it bounced off of the 50-day, you could have made a play off of it by buying it right here. If you bought it right there, you might still be in. I'm not sure. I'd have to measure that, and I don't want to do that because of time constraints. You might still be in. Certainly, we've got 1, 2, 3, 4, 5 sell days in a row, so violations are piling up. Volume is higher. It looks like, this trend channel is definitely blown up. Now, if by chance you're still in, and it sounds like you probably aren't, there's a decent chance it will get support in this 200-day. There are probably institutions that have been watching this stock for months, waiting patiently for it to touch its 200-day. And when it does, it may well, that might be the bottom of a new base. So if you see, if it sits on the 200-day, then just watch it. But if it gets a strong bounce, then if you want to try it again, or those of you who aren't in it, that would be a place to try it. But yeah, that's disappointing price action for sure. When you're in a trend channel, the earlier you can get into it, the better, because it's kind of like playing Jenga. These trend channels get a little weaker and weaker and then ultimately fall apart. Let's see, AIZ, this is running hot. Does it still have legs? Let's see, 20-year chart. I think it does. This is certainly my opinion, and anything can happen, but it's in a hot industry. Insurance, ranked 20th out of 197. Really good money-making company. Great earnings. You got a nice little dividend. The reason I think it still has legs, this is the 20-year chart. It's just making a nice cup here, and it's up here near the top third. Ideally, you'd like to see it pause out and make a handle and then break out of the cup. I don't really see a good example on here. I suppose right here. You got this big blast out on earnings, and it's just in a nice little uptrend here, right? I would just let it run. You got that nice little uptrend. I don't know where your buy point is. If you can, I would try to keep a piece of it as long as it stays above this 50-day moving average, and just play it for a longer move and wait patiently for it to break this 50-day. It might keep running for another few weeks or months. And lastly, NIO, I know this one really well. Chinese electric vehicle company. During the EV craze of 2020, it just absolutely exploded, and I played part of this move, not nearly enough of it, unfortunately. But they just have been having trouble with profitability. They have a battery swap model, which was a pretty good idea a few years ago, but now the charging systems are much better, and now that you can charge EVs pretty quickly, the battery swap model is not particularly viable. Now in China, it's a little different because a lot of people are in apartment complexes and can't plug their cars in easily. But as far as right now, this is just ugly. If I was going through charts, I'd spend 3 seconds on this chart and move on. It's trying to put in a bottom here along 7.25, starting to slide sideways a little bit, but the 200 days still in a downtrend. It's technically still in a downtrend. I'm not going near this anytime soon. I suppose if it cleared all of this potential supply here and got to maybe 16 or so, or even 20 would be better, and then started to build out an orderly looking right side, that's where I would probably initiate a position. This really looks ugly. I definitely wouldn't be going long or short. If you're in it, you're kind of in no man's land here. I really can't give you an opinion on what to do if you're already in it. I like the old O'Neill saying, cut your laggards and let your winners run. So I would probably be cutting this laggard honestly, unless you know something about the fundamentals that I don't. Okay, guys, I'm going to wrap it up there. Thanks for your questions, and I encourage you to check out my Patreon. I do a weekend video of my portfolio and focus list, and I do a blog post or two during the week. I also encourage you to check out my Patreon, my partner, Seeking Alpha, which is a wonderful database, I guess we can call it, software platform for doing fundamental analysis. You got news, you've got analyst articles, etc. Let me know your thoughts and questions, and I'll see you in the next video.